In this chapter, we are going to discuss about private equity performance ratios because ratios are very important. If you don't know the different ratios, then you won't be able to calculate or measure the performance of private equity funds. And that's what in this particular session we are going to cover the top 10 or top 15 different ratios which helps you guys to understand the performance indicators of private equity funds. So let's start with the discussion. If you ask me what about the outcomes of this particular session is, I would say our main key focus would be on understanding the key financial indicators of the private equity model or fund, I would say. Then second, private equity fund metrics provides means how private equity fund metrics provide quantitative measures to evaluate the performance of private equity investment. Third, if you ask me how this metrics or ratios going to help, I would say this metrics will help investors, fund managers, and stakeholders, it means including government bodies and all. So it will help to them as well to understand the different aspects of private equity fund. And apart from that, we're going to, as I said, we'll discuss about the different ratios. So let's start with the different ratios and understand it how those are important and even calculated as well. So let's start with it. So before that, before go ahead with the directly touch to the ratios, before that I would like to explain about why P ratios are important. Right, we have discussed about learning outcomes, but here I would also like to highlight why the ratios are important. So if you see, if you see any question as such around your interview also, that you can explain like why ratios are important or metrics are important. The first one is that metrics will help you to evaluate the performance of a fund. So it means how your fund, let's say, achieve the preset benchmark returns and all. If you want to calculate that, then ratios will help you to get better insight about performance or success of the fund. Second, investor accountability. That ratio, see, nobody checked line by line business transactions, nobody spent it, even investors, fund manager, nobody checked it. What they want everything on dashboard, which provides insight on different ratios. And exactly, if you see all ratios that demonstrate the more transparency as well as more information or insight about the fund performance and other aspects also. Third point here, I would like to quote about decision making. If you have, let's say, metrics in place, then you can easily take the decisions, right? You can easily evaluate the different portfolios. You can easily change the investment strategies. And if you don't have a metrics in place, then it would be very difficult to check the line by line transactions and then take the investment decision. But yes, so as we discussed, we have a metrics in place, and those metrics helps to the fund managers to take investment decisions. Then another point is risk assessment. Of course, if you are not able to identify the risk, or if you are not able to ensure the capital allocation and all, how as a fund manager, think about it, how you can achieve the best mark. You won't be able to do it, and that's what metrics will help you to identify and mitigate the risk. And apart from that, how you can allocate capital to the different asset classes effectively. So it means metrics will help you for that. Another point is benchmarking. Benchmarking is nothing but it's just uh, compare the fund performance against the industry standards. For example, let's say Standard and Poor, Nifty, all right, Nasdaq, Nikkei. These are the benchmarks, industry standards, I would say. So you can compare your funds with the benchmarks. For example, let's say benchmark grows with 20% appreciation, then you can compare that 20% with your fund, how much value that your fund has generated throughout this, let's say 1 year, 2 year, 3 year. Right, so this is how you can compare. But yeah, benchmarking is also one of the standard metrics which helps funds to evaluate the fund's performance against the industry standards. Then alignment of interest. Alignment of interest, it means because always you would see two counterparts, one is general partner and another one is limited partners, and of course about their fair profit distributions as well. So means equally the profits, cost, expenses, whatever it is, it should equally distributed among both the counterparts. And that's what alignment of interest also that you would see in place. And then again, next one is capital allocation. As I said, if you don't have a metrics in place, and if you, let's say, if you don't have effective capital allocation strategy or planning in place, then you won't be able to generate the returns. And that's what metrics helps you to allocate capital to the different asset classes, right? Then again, fundraising tool as well. So metrics attract potential LPs with a strong, that matrix, it means gives a strong history, or I would say presentation that how fund has been performed throughout this, let's say period or duration, whatever it is, the investor is looking for. But yeah, if we have a metrics in place, that metrics will help you to calculate the different different performances or different things, and that help you to discuss with the investors. So it means if you have a metrics in place, so that metrics will help you to understand or even the investors to understand about the fund's performance and everything. Then performance improvement. Metrics will help you to identify underperforming assets. And again, you can identify or enhance the operational efficiencies through your metrics, right? Metrics means you can set the metrics. Let's say if you have invested in 10 assets and you have set the benchmark 10% for next 1 year. If you see any assets, if not achieve the 10% bar, so it means that asset is underperformed. So you can change your strategy with that particular asset. So this is how you can, take the full leverage of different metrics in your private equity business. And then of course, highly important is exit strategy. Metrics will help you to planning your exit strategy from the XYZ company or investment. Then track record, of course, metrics will help you to build a track record for a future fundraising and even attract top tier talent also. And other two benefits or other two, I would say, points that you would see: communication tool as well as regulatory compliance. This metrics will help you to build sound, regulatory reporting disclosure requirement, and apart from that, you can see it will facilitate communication with the LPs as well, because LPs will check all of this and then accordingly they'll perform it. So this is how your fund metrics works, or I would say this is how your fund metrics provide you all of this benefits and all. Now if you see any question as such around why P fund metrics are important, I'm sure you would be able to explain it at least, or answer to the questions. So next, Next is, so now here we'll discuss, or we'll directly start with the different ratios. Right? When we talk about ratios or metrics, it means the first metrics is IRR. IRR, it means internal rate of return. Right? So if you see, the IRR is the annualized rate showing the growth of an investment over time, and it indicates the break-even point when considering the time value of money. So it means IRR consider the time value of money. Time value of money is nothing but the adjustment of inflation, and I would say DCF, apply the discount factor to the net cash flows, and then after we calculate the internal rate of return. So if you talk about usage, investors use IRR to compare the profitability of different investments. If investor want to calculate the let's say performance of the investment, assume it one investor invested in two funds, right? One fund is offering 14% IRR and other fund is offering 20% IRR. Of course, investor will invest in 20% IRR fund, because if the IRR is higher, it means that investment is good for a investment. So this is how you can use, or as a investor will use to take the investment decisions, right? And apart from that, it helps understanding the potential return on an investment over the time as well. So this is why this matrix is important to take the investment decisions, and as well as to calculate the potential return on an investments also. We have an example. Suppose a private equity firm invest 1 million in startup. After 5 years, the exit investment receiving 2 million based on the initial investment, and the final return over the 5 period, the IRR for this investment is approximately 14%. So it means in this particular case, we have considered, or IRR by default that considered the adjustment of inflation, as I said, or the discounted rate which will apply to the net cash flows, and after that it will be calculated. I'll share you the link or Excel sheet in the description. You can refer that for a calculation of IRR. But yeah, IRR is one of the important metrics to measure the fund's performance as well. If your fund performs well and provide, let's say, higher IRR, so it means your fund performs well. So this is how you can relate. So the next one is time value. Next one is total value to paid in. Next one is total value to paid in. What it means, total value to paid in? So this TVPI measures the total value of the current investments and distributions. Here we are talking about current investments and distributions relative to the amount of capital paid into the fund. What is the usage of this particular TVPI ratio? TVPI gives investors a snapshot of the fund's overall performance. It helps in understanding the total value generated by the fund relative to the capital invested. Here we are talking about three things. One is capital investment. Another one is return of capital. And the last one is remaining value also. If we see any amount in the fund, so we are talking about that as well. So let's take the example how it works. If a private equity firm has received distribution of 0.5 million and the remaining portfolio is valued at 1.5 million, and the total capital paid to the fund is 1 million. So the TVPI would be 0.5 million plus 1.5 million, which is portfolio value, divided by capital. It was paid, right? Here we are comparing what amount the investor paid and how much amount investor received, and what is the value which is remaining in the portfolio. It's a comparison with that, and if you calculate it here, the return would be 2.0x. So it means eventually your investments got kind of doubled, right? In that way, 2x, it is f 0.2x, it means it's a positive returns, right? That gives us the fair understanding of your investments, performance. So this is how you can calculate and even relate. So your third would be distributed to paid in. Distributed to paid in, it means here we are talking about distributions, and we'll compare distributions with the invested value, right? How much that we have paid it and how much amount which is still in the vehicle, and we'll compare the distributions with the invested capital. If you see, DPI indicates the amount of capital that has been returned to the investor relative to the amount they invested. It's just a comparison between invested amount and the distributions, right? Or distributed profit or distributed capital, whatever that you can say. DPI helps investors understand how much of their invested capital has been returned, right? And it is measure of the liquidity and the realized return. Let's take the example. If investor have received distribution of 0.5 million from a fund in which they invested, so it means 1.1 that investor invested, and 0.5 million where that investor received it as a distribution. The DPI it means distributed to paid in, or remaining, which is, if you see, 0.5 million divided by 1 million. So it means 0.5x which has been distributed to the investor till time. 0.5x which has been received to the investor against the capital invested. So this indicator helps investor to understand how much amount that the investor received, right? And how much amount that the investor has invested in this particular pool or vehicle. I hope you got this idea about how investor invest, or how investor manage their distributions, distributed portion, or how that investor compares with the capital invested and all. See, if I provide you formula and this one, you can easily calculate, right? Instead of checking line by line transactions. So this is how fund works, and even investors also. So another one is residual value to paid in. Residual value, it means remaining value. Here we are talking about remaining value in the fund vehicle. RVPI represents the value of the remaining in investments or in a fund relative to the capital paid in to the fund. So here we are comparing with remaining value and distributed amount or paid in. So if you see, RVPI provides insights into the potential future returns from the fund, and it helps investors gauge the unrealized value in their portfolio, indicating the portion of the fund's value that has not yet been returned to investors. If I put it everything into this example, let's say if private equity fund has a total portfolio value of 2 million, total value, and has already distributed 0.5 million to its investors with an initial capital paid in of 1 million, and the RVPI is 2 million, it means total portfolio value minus distribution divided by this 1 million, it means capital. If you compare it 1.5x, what it means here, the remaining value is 1.5x. Remaining value in that particular fund portfolio is 1.5x. So it means, in short, 1.5 million is still pending, or still which is in the pipeline or portfolio after the distribution, because 0.5 million has been already distributed and remaining value of the portfolio is 1.5x. So this indicator basically helps to understand the remaining value of the portfolio after the distributions of profit or capital or whatever it is to the investor. And even the same applies to the investor as well. Investor also will check the same thing, and it will, and then they'll relate it. Okay, so my 1.5x which is still pending or remaining, or let's say residual value with this XYZ portfolio kind of things. All right. So the next one is cash on cash. Cash on cash, it means cash on cash measures the return on the actual cash invested and disregarding any leverage or borrowed money. So let's see the usage of cash on cash. This matrix provides a clear picture of the actual cash return on the invested capital. Actual cash return on the invested capital. It is useful for understanding the direct profitability of an investment. So it means this particular matrix helps you to calculate the total profit. Profit means how much profit that you have received. Let's take the example. If a limited partners contributes 0. Not 0. It's a 50k to a private equity fund and later receives distribution of totaling 100k, the cash on cash return is 100k minus 50k divided by 50k, because 50k it was invested amount. Invested amount is 50k and you have returned, let's say if you are an investor, then you have received 100k. So in short, if you see your investment got 1x, so it means 1x, it means 100% return. So value of your portfolio now, let's say it's a double, so you have 100% profit in your portfolio. So this is how you can calculate, because invested amount is 50k and received amount or return amount is 100k, so it means you have 100% profit. And how you can measure is distribution of totaling minus contribution, distribution minus contribution divided by again contribution. That helps you to calculate cash and cash on cash metrics. I hope you got this, how you calculate and why this is so important. Another one is net multiple. I'm sure you would have heard about net multiple. Net multiple, it means it measures the total value of an investment relative to the amount of capital invested. If I talk about usage, so this matrix helps investor to understand the overall profitability of their investment. All right, and it provides a ratio that indicates how many times the initial investment has been returned. For example, now if I put into example, then you can relate. If you see, if a private equity firms invested 0.5 million in a startup and the current value of that investment is 1 million. So net multiple, if you talk about, it's a very simple, right? Current market value of investment divided by capital invested. If you see, if you multiply this, if you divide with this, 1 million divided by 0.5 million is equal to 2x. So it means your investment has 100% return. Simple. So in short, how many times your investment has been multiplied, right, with the same invested capital. So that insight will be provided by the net multiple. Net multiple is nothing but your how many time in a multiple itself. If you see how many times your net means investment has been multiplied. Let's say you invested one, right now the investment, let's say has been, current market value is 10. So it means if you see 10 time your investment has been, sorry, not 10 time. So if you see in a percentage, if you calculate it, it seems like 10x. 10x, it means almost 1000%, in that returns that you would receive when you sell it out. So same way you invested 0.5 million and now investment value is 1 million. So it means you have 100% return. Your investment got double 2.x return that you have it. So this is becomes your net multiple. Net multiple, it means your investment has been multiplied, or your investment has been doubled in that way. All right. If you see, any of the metrics is negative, so it means your fund is not performing well, in short. So I hope you got this. Residual value that we have already discussed. I'll take you ahead. Gross profit portfolio. Gross profit portfolio, it means the value is the total value of all investment, right? Gross portfolio value is the total value of all investment currently held by the fund, right? Let's say you have investment in 5 to 6 portfolios, so you can take the value of all portfolios, just combine it and then calculate. It's just a value, gross value of all portfolios, right? Then usage matrix provides, if I talk about usage, so this matrix provides a snapshot of the fund's current potential worth. It's just a simple calculation that this matrix provides you the insight of total value of all portfolios, as I said, and it helps investors understand the total value of their investment at a given point in time. Whatever, let's say if I calculate today, or if I calculate the value of all my portfolios, and if the values, let's say in A portfolio the value is 0.2 million, then B is 0.3, then again here with a C, let's say company, the total investment value is 0.4, 0.5 million, D and E. If you total of all portfolios value, current value, so that becomes your gross portfolio value. That becomes the gross portfolio value. So gross portfolio value is here 2 million. It's just the addition of all your portfolios. All right. So next is exit multiple. So if I talk about exit multiple, it means, see here we are talking about at the time of exit how much value that you have received. Simple, right? Exit multiple is the ratio of the exit value of an investment to its original cost. As I said, you can compare your exit value with the original cost. It means capital. You can compare with capital invested. It helps, if I talk about usage, it helps investors understand the return on their investment at the time of exit. At the time of exit, how much amount that you have received. It will talk about that, right? A higher exit multiple indicates a more successful investment. So it means if you have a higher, let's say multiplied 6x, 7x, 10x, 100x, so it means it seems like you have a more successful investment. For example, if private equity firms invested 100k in startups, $100k in startups, and later sold its stakes for 500k, right? The exit multiple is simple. So exit value is, this one is exit value divided by capital. If you calculate in this way, whatever that your result would be, that becomes your exit multiple. In this case 5.0x becomes the exit multiple. Let's say you have a investment with this, right, 5x, and you have a B investment with the same amount, but you have received less amount, assume it, and that x comes at 3.0x. So of course your A investment is better than B. So this is how investor or the other fund managers also they can calculate it, the returns of that particular investment or portfolio. All right. Then capital called. Another important metrics is capital call. Capital call is the amount of committed capital that the fund has requested its limited partners. See, in a private equity, always you would see where fund managers signed commitment with the limited partners as well as general partners as well. Both, if both are different. Because limited partners and general partners, or basically I would say limited partners, they invest in private equity funds, and fund manager just operate or manage the investment task or activities and all. Where fund manager ensure that fund manager has a signed committed capital authorization letter where fund manager can initiate the capital call request to the fund as and when required. But how fund manager can ensure that, how fund manager can calculate that, it's very important, because if you don't have a metrics in place to help you to understand how much capital that you have called from the committed capital, then it would be difficult. And as I said, nobody check the line by line transaction, but if you see this metrics help you to compare capital called with commitment. So if I talk about uses, this matrix indicates how much of the committed capital has been put to use. It helps investors understand the fund's activity and capital deployment rate. If I take the example, so let's say if investor have committed 1 million to a fund and the fund has called only 60%, so it means capital called is 0.6 million or $600, right? It's a compare. How you can compare capital called divided by committed capital. So it will help you to calculate or to understand the called capital percentage. In this case, 60% capital that the fund called from the limited partners for investment purpose. All right. So next one is capital committed. Capital committed is very simple, right? Capital committed is the total amount of money that investors have agreed to contribute to the funds over its life. It provides a clear picture of the fund size and the total capital available for investment. Why this ratio is why this matrix is important, I'll tell you. See, without understanding or knowing the committed capital, fund manager cannot go ahead and make investment, because fund manager should know it, the committed capital, or how much capital that fund manager can raise to invest in XYZ securities and all. And that's what capital committed metrics is also important, right? If I take the example, let's say if 10 investor each commits 100k, a private equity fund, the total capital committed is 1 million. So it means total of all 10. If 10 investors, let's say, commits, that becomes 1 million capital. And 1 million, if you see, means each commitment or committed capital is equal to your total capital committed. If there are 10 investors, this 10 it means investors, and this it means contribution plus into investors, total number of investors your is equal to, it would be your committed capital. So this is how you can calculate capital committed for that particular funds. Capital distributed. This matrix is also important. Capital distributed. How much capital that you have raised and how much capital that you have distributed, means return to the investor. Here we are talking about returns to the investor. Capital distributed is the total amount of money returned to the investors from the fund. In short, how much amount that we have returned, that we're gonna compare with the capital, including return on investment. So it means here we'll take the return on investment as well. And this matrix helps investor understand the returns they have received from the fund, and it indicates the fund's success in generating positive outcomes for its investor. All right, if I take the example, if private equity fund returns 200k in profits along with 500k of its initial capital to its investor, the capital distributed is 700k. So here we're gonna just discuss about distributions, how much capital or how much, not only capital but gain also, how much gain that we have distributed to the investors or fund distributed to the investor. So total amount that fund can highlight in this particular matrix, and even investor can also understand the same thing, so that how much amount that the investor received from the XYZ fund, maybe in the form of capital or maybe in the form of gain or whatever, in other form also that you might see. So let me take you to the next one. Realized versus unrealized. Realized versus unrealized. It means realized and unrealized are the terms used to describe gains or losses on investment. A realized gains or loss occurs when an investment is sold, while an unrealized gain or loss refers to the potential profit or a deficit on an investment that has not been sold. Realized returns, this is the return from investment that have been exited or sold. It is concrete number that reflects actual profits or losses. Realized it means this is the return from the investment that have been exited or sold. When you sold the investment, whatever positive number or appreciation that you would see, that becomes your realized number. For example, let's say you have invested USD and you have returned 20,000 USD. If you see 10,000 USD becomes realized profit or realized return. And if I talk about unrealized, it means this reflects the potential return on investment that are still held, your portfolios still, which is hold that percentage or investment, I would say, in that XYZ portfolio, means yet to sell. Once you sell the investment, that becomes realized, and if you have investment but yet to sell, that becomes unrealized, and it is based on the current valuation of the investment, which can fluctuate. So that depends on the market circumstances or force as well. If the market force, if you see high force, positive force, negative force, then if you see the fluctuation in value as well, and then effect on unrealized returns also. If I talk about usage, so this terms helps investors differentiate between actual returns and potential returns on their investments, and they are particularly relevant in the context of private equity, where investments in the startups can take years to mature, and metrics that these terms apply to include, right? Imagine, let's take the example, imagine a private equity firm that has invested in two startups, company A and company B. If I talk about company A was invested in 5 years ago at a valuation of 1 million, and the VC firm, let's say, recently sold its stake in a company A for 5 million. This result in a realized gain of 4 million. It's simple calculation. When you sell the investment, then eventually you will receive a realized return. And if I talk about company B, B was invested in 3 years ago at a valuation of 2 million, and it hasn't been sold yet, but its current market valuation is 6 million. So this is becomes again 4 million becomes unrealized gain or potential gain from the investment. In this scenario, the VC firm has realized gain of 4 million from company A and unrealized gain of 4 million from the company B. The total potential profit combining both realized and unrealized gains is 8 million. And however, it's crucial to note that the unrealized gain is not guaranteed until the investment in company is sold. I hope you got the statement and could change based on future valuations. All right. So this is how your metrics works in private equity business. So the conclusion of this chapter is, even private equity or venture capitals, metrics are essential tools for evaluating the performance of a private equity investments. By understanding and utilizing these metrics, investor and even fund managers can make a more informed decisions and optimize their investment strategies and all. As I said, so nobody checked the line by line statements. Even if I talk about fund manager, or even if I talk about, let's say, investor, nobody checked it, because what we want all of these ratios on one page, which can defines everything. What we want is all ratios on one page, so that it's kind of a dashboard, so that help us to understand the investment situations, total distributions, remaining amount, remaining capital multiplies the total valuation of portfolios, gross valuation, net valuation, and everything means everything. So nobody is interested in to check all the line by line transactions. That is a job of fund accountant to check it all the line by line transactions, not the fund managers and investors. But yeah, so as I said, this matrix helps to the investors, fund managers, even regulators or governments or other stakeholders who are interested to compare the performance of funds, their funds with your funds, or maybe you would say different perspectives of this matrix as well. But yeah, so if you see, metrics are important one, and I hope you got the all metrics with example. I'll share this PPT in the description. I'll share you the link so that you can download and refer for your understanding purpose. If you are looking for a private equity accounting interview, I'm sure that you would see questions around it. And otherwise you can for your, if you want to become a, let's say, fund manager, or even though investor, if you want to invest in private equity or maybe venture capitals and all, you can refer the same ratios that help you to gauge the performance of your different portfolios or funds, I would say. With that said, i'll uh, I'll take a leave now. So we'll see in the next session about all of this, all right, or on a different perspective, I would say. So thank you for watching this.